Hello everyone, welcome to my YouTube channel. This is Accountancy for You. So today we will be solving the second question of accounting ratios. It's about current ratios from T.S. Groval's analysis of financial statements, and I hope my video solves all the doubts you have regarding this question. So without further ado, let's get started. Now, the second question says that we have to calculate the current ratio from the following information, which is total assets 20 lakhs, fixed tangible assets 10 lakhs, shareholders funds 12 lakh 80,000, non-current liabilities 5 lakh 20,000, and non-current investments 6 lakh. So now here we know that current ratio is equal to current assets by current liabilities. I'm just using short forms for now. So now what exactly are these current assets and current liabilities? Current assets are all those cash and cash equivalents such as bank or check, or any other assets that can be converted into cash or cash equivalents within 12 months of time or within the operating cycle of the business. So it's like a list of cash, bank, and the trade receivables, which include debtors or bills receivables, then the stock or inventories of the company, excluding the loose tools, and then there's the accrued income, then prepaid expenses, which can also be called as advanced expenses paid in advance, and then our current investments or marketable securities, which are actually the short-term investments. Right. So those are the entire list of assets which mainly compose current assets. Now, from the list of given items, let's just draw a mini balance sheet to get things more clear. Right, so mainly, since if we call this the liability side and the asset side, right, there are three main categories of items that come on both these sides. On the liability side, we have the equity, and this equity is actually the shareholders' funds given in the question. So another name for equity is shareholders' funds. Then there are non-current liabilities, which is also known as debt or long-term liabilities. And then the third item is a current liability. Now, our current liability are all those liabilities which we have to pay off within 12 months or within the operating cycle of the business. Non-current liabilities, on the other hand, are those items which you don't have to pay within 12 months. I mean, we can, but then we have to pay it, we can pay it even after those 12 months. But whatever that we have to pay within 12 months fall under current liabilities. On the asset side, we have the fixed assets, which are the fixed tangible assets given in the question. They both are the same. And whenever you calculate fixed assets, it has to be net fixed assets, which is fixed assets minus the depreciation calculated for those assets. Then we have our long-term investments. And these both together compose the non-current assets. Then there are current assets, which we just explained. Right. And the question, and this side comes to total liabilities, this side comes to total assets. These both are always going to be equal. So here we have total assets. We need current assets. Fixed assets are given as fixed tangible assets 10 lakh. Non-current investments are given 6 lakh. So current asset will be total assets minus fixed asset plus long-term investments. So current assets equal to total asset minus fixed asset plus our non-current investments. Total assets are 20 lakhs minus fixed assets are 10 lakhs plus non-current investments are 6 lakhs. Alright, so this will be equal to 4 lakh. Right. Now, next comes current liabilities. Now we know that the shareholders' funds are equal to equity, it's the same. So we have equity given to us, but we don't have total liabilities, current liabilities, and we have non-current liabilities given to us. So how do we find this? Now we know that total liabilities are always going to be the same as total assets. So current liabilities are going to be total assets instead of total liabilities. So total assets minus the equity minus the non-current liability, that is total assets minus equity plus non-current liability or debt. So current liability is equal to total assets minus our equity plus debt or non-current liability. Right, total assets come to, again, 20 lakhs minus the equity, shareholders funds, 12,80,000, plus the debt or the non-current liabilities, 5,20,000. When we calculate this, we get the current liability to be equal to 2 lakhs rupees. Now the current ratio, as we can see here, is current assets by current liability, which is equal to 4 lakhs by 2 lakhs, which is equal to 2:1, which is the ideal ratio for current ratio. And that is the end of the question. We reached the answer. So I hope this question has been clear for all of you, and do let me know if you have any doubts. I'll clear them in the comments, and don't forget to like, share and subscribe. Thank you.